Hi, Mom. Have special guests today. All right, if anyone has anything they want to discuss. Okay, SMCI. Yeah, I've tried to warn people to stay away from that. We're more in the NVIDIA camp. We had talked about ASML and SMCI. I mean, SMCI, they can't even get their auditor together. So I don't really see, what's the right price? I mean, could it be a zero? I mean, I doubt it, but could it keep going lower? Could this be a single digit stock at some point? I mean, it could be. That's all I have to say is until there is bad news and the stock stops going down on bad news, that to me is you got to just stay away. If you want to do something with buying some leaps or something along those lines, and you're willing for them to go to zero, that's on you. But as far as an investable type of a situation, I'll take NVIDIA every day of the week and twice on Sunday over SMCI. ASML, I mean, they stunk up the joint also with a couple of back-to-back crappy quarters. I do like today's price action, though, with the gap up. But, I mean, what did you do today? I mean, you just filled the 1029 gap. So I'll tell you what, if you want to be long ASML, this is going to be famous last words, but I'll bless it as long as it stays over the 20 MA here at 690.59. Below there, I think it's toast. The big question is, was today's gap going to be the pro gap that gets things going? It's not really clear to me because it's a bit of a small gap and we're still below the 734 quarter breakdown level. And I mean, where are you really going to rally to? Maybe the 50 MA up here at 758.68. I mean, I'd take those points, but I'll tell you what, let's put a buy alert over high of day here at 712. And if that triggers, you could use that as a catalyst for the long and then use whatever today's close is as the stop at 698.20, assuming it isn't a big expansion of range from here. If you want to use the candle body high, I'm good with that too at 706, let's say 705, so we have a little wiggle room in there. I'm looking at the futures here, and it's very interesting what's going on. Today, to me, looks just like algorithmic trading, running them up and running them down. If you look at the break of the neckline at 59.90 quarter, it quickly went back up, took it out again, and now we're back up above it. So it shouldn't go through that again. I think you could use 59.90 quarter. And where would we run up to? Probably 6,013 half to 6,019 half-ish also, because that's the 200 MA. There has been some trade on the top side of the 200 MA pre-market, but hasn't really been able to hold. And we saw that liquidation break off the open. I guess they wanted to blame it on the PPI. It's sort of like Milli Vanilli style, right? Blame it on the rain. To me, it just looks like markets are still consolidating up near highs and not really giving a lot back, but not adding a lot more on either. I'm just looking at the PPI data here. The prior readings were adjusted up, so that is negative. And this month's looked okay. I mean, they don't look, a little bit hot, ex food and energy. So yeah, I mean, not so great. Not so great. Month over month and year over year. Yeah, this was a hot PPI data, and that usually does translate into CPI if that can be pushed on. I'm seeing a little bit of a bounce here in futures. By the way, we need to talk a little bit about Qs as well. The apples to apples neckline on the Qs, I'm using 21,054.75. The equivalent of the 6,013 half, which is really the initial leg dump, I would say we could use 21,121.75. And if that were to clear, there could be some room up to the 200 MA, 30-minute, wherever that is at the time. It's currently 21,188. My guess is it'll be a little bit lower, probably closer to high of day if we were to get there. Price is still below VWAP, and moves above it today have not been able to sustain on any closing basis. Currently in the ES, that's 6,002, and in the Qs, that's 21,102. I just think that we're in this situation here where we got up to 6,000. There was a little bit of an overshoot, I guess, probing above it. And it looks to me like controlled distribution the last few days, that just traders and firms are taking the opportunity to lock in some of those gains. Today, other than the last hour in candles, looks like an entire distribution day in terms of the Q ticks. The ES isn't quite as bad, but also to me looks like a distribution day. The breadth is mildly positive, and I mean just like on the right, just on the right side of the 1-to-1 positive. If you took a bathroom break, you could miss that. And the AD line is kind of cruddy, but I haven't gotten interested in the bear case here because the VIX can't get itself arrested. It just keeps bleeding out and bleeding out. I mean, to me, I'll tell you, at this point, it looks like we could bleed down into the 11s. I still think the risk for lower VIX here is the 1-to-1 payout, as opposed to now the 3, 5, and 6-to-1 positive on the upside. I mean, I do think at some point we will retest those 23s, but until that clears, is it really just a controlled range in the VIX? That's my thinking at this point. And it doesn't look like sellers are able to get a real foothold. I mean, I'm looking at these volume candles. Other than the dump on the open, there's really nothing that's impressing me in terms of this downward press. So it's very hard to get going with down moves when you don't have the volume on your side, and there's been nothing in terms of volume or volatility. So that's just a big L for the bears. Taking a look at Tesla, still bleeding out, one time framing to the downside. My guess is that they're going to try to test the 10 MA, wherever that is at the time. It could be the 299s to 300, which really just blew through to the 320s and then beyond. So it seems to me like it's just marking a little bit of time. We are back into the channel, though. I mentioned yesterday I'd be down to do the 300, 270 put spread with maybe an overwrite closer to the 100 MA around the let's say 235, 240 strike. I still think that that's okay if you're longed up here, and if you want to go a little longer dated, maybe sell some 400 upside calls to fund some of that. NVIDIA still looks fine to me. I told you that I had been short put spreads, bull put spreads to buy bull call spreads, and I was sort of running out of time. I honestly didn't make that much money on the calls, but I did make good money on the short puts. So I did book the calls for a gain, and I did that 3 sessions ago. I guess I'll pick up where I left off here. I was talking about NVIDIA, that I think it still looks okay. I had been in a long call spread, bull call spread, and a short put spread, bull put spread. And I made some good money on the puts. I took those off, and then I booked the calls 3 sessions ago and then 2 sessions ago when I hadn't gotten the full fills. And I used that up pop to do it. Why? Because I just felt I was running out of time with 2 or 3 days to expiration, and a market that's kind of at highs, seemingly a little bit stalled out. And all I would need is a day or 2 down, or just even flat, to crush that premium and destroy the trade. So I had posed that I was into either just taking it off, or if you wanted to, if you were following along with this, re-up the trade. Next week is earnings, so those options are the most juiced. If you wanted to buy the 150, 160 call spread and let's say sell 140, 135, if you've got the huevos rancheros, you could do 140, 130 and take in a little bit more premium and reduce the cost of the trade to, it could fill right now for 43 cents. If you bump that up to the 135 again, it's 140. It says 140 to 143 at the moment. But the reason I like having the narrower spot on the put side is because, number one, it's still near the highs, and number two, the asymmetric risk. I mean, I guess those options are more pumped because of the earnings situation, but they're not really that dramatically more. I mean, yes, they're more than the ones expiring tomorrow, but if only 83% IV, and then after that it dumps to 68, and it only gets down to 59 in the December OpEx, and if I go down, I'm just looking at the option statistics, and we're only in the 49% IV percentile. So that to me isn't even over half. So that's why I want to limit my exposure on the downside. Here we go. Futures again dumping a little bit, just kind of bleeding out. To me, the risk looks like we are now back below the 2-day lows. It doesn't look like there's a lot of commitment down there, but if it does keep going, we're very close to the 2 times range. I may have to adjust that to factor in the neckline. as opposed to the initial dump lows. But as of now, it would be 59.74 half and 59.50 half in the Qs, 20,902.75 and 20,767 half. So those are potential downside targets if we can't hold right around here. Again, if you came into this a little bit late, I will combine the rebroadcast. It's super annoying that this keeps happening where it cuts out, but if you could do me a solid and like and retweet the post, that helps very much. You want to talk UAL. Let's take a look at this. If you have, by the way, if you have anything you want me to discuss, just type it in the chat here. UAL, a couple of topping tails here. I mean, if you're long, I'd probably be booking it. The money flow is definitely not confirming these new highs. I mean, is there room still higher? I mean, there is a little. Back in 2019, we were at 93 bucks. I mean, to me, the risk reward up here does look a little bit stretched. And with the money flow not confirming, that to me is a little bit dicey with a couple of topping tails here. If we were to have another one tomorrow, you could have a secure high situation. I mean, it's tough to just pick tops, but if you wanted to try short, 93.33 high of day would be a stop. Downside target would be the 10 MA at 85.79, which to me looks like it's been bought the dip. I generally like to be long things above 10 MAs and or stopped out or short things below 10 and then of course 20 MAs. And you can see here NVIDIA again rolling over a little bit, not exactly lighting the world on fire. I think a lot of the problem has been the strong dollar. Now we are getting up to some key reference areas at 107.113 to 107.348, and I only really feel comfortable saying the dollar's march higher may be blunted or muted back below 106.517. That to me, I mean, it's moved almost $7 in a few weeks here, so that's a pretty big move. TLT is seeing a bit of a bounce. I did put on that trade toward the close yesterday. I'm not loving today's candle here. If you're short, you could use 91.03 as a lowered stop. For the Mobros, we got to get over the 20 MA at 91.84. The trade I put on with this is I did it small size, and we'll see if I wind up getting stopped out or not. But in January of 26, so I mean, you're talking about 428 days to expiration. I'm short the 85 puts, long the 80 puts, long the 90 calls, short the 100 calls. If it starts really going against me, I could lower my 100 down to the 95. That is sort of my upside target here to somewhere between 95 and the 96.74, which was the 10-3 gap fill. By the time it would get there, depending on when this takes place, it could be the underside of the old up channel, and that to me could even be a reload for a potential short. I'm just seeing this breath is starting to roll over a little bit again here, a little bit 1 plus, 1 plus negative, just barely, just like it was 1 plus positive on the upside. Really not very impressive moves either way here. To me, again, it just looks like a little bit of profit taking, and we are starting to break some consolidation range lows, though. I mean, it does look to me like the market is a bit stretched, and you're still seeing some 600 sellers plus. And the fact that we can't get up over there, you're seeing the liquidation break. We are now right on the trend line. If this were to fail, the obvious next downside targets would be the 10 MA, currently 588.85, and then the breakout retest from 1017, which will probably line up with the 20 MA by the time we get there at 586.12, and the 20 MA is currently 584.38 and rising. My big question, though, and I'm sort of wondering if we're going to see a bit of a rounding top here and a potential head and shoulders. But if that were the case, I mean, you're looking at a neckline much lower, I mean, at 567. So if you wanted to hedge up here and you wanted to put on some cheap premium, buy maybe 590, sell 560, 30 bucks wide or so. That's roughly around the 100 MA. So I'm good with that. If you want to do an overwrite down closer to 540, which is the 200 MA, I'd be good with that if you want to go a little bit longer dated. I'm going to take a look at that option series right now because I like putting on those trades. The only thing I caution is that you got to do it smaller size with the overwrite because of the low IV. And if you want to wait for the overwrite, you can. I'm sort of mixed opinions on waiting on the overwrite because the whole idea is to sort of, I mean, it's not sort of, it is to help you weather option time decay if it goes against you. And I already have something on in December here, but it's much lower strikes with the 565, 545, 530. So if I want to put on some more, let's say we did the 590, we sold let me just work this up, 575, and what did we say, 530? I'm going to play with those strikes in just a second, though. I'm already short the 530. Let's say the 535. So am I comfortable doing that? It would be $2.59. If I wanted to lower the cost of the trade and I still think there's going to be a dump, I'm good with doing, yeah, this to me looks a little bit cheaper. The 585, 570, 535 in the December OPEX you could get on for $1.72. And if you want to lower your cost, you could sell the 600 and maybe buy the 605 just to lower, I mean, oh, what happened there? Oh, you can't do the fifth option leg. You'd have to do that separately. So that's super annoying. But you could obviously reduce your costs with doing that. I'm good with doing something like that. I may actually, let me see if I can fill something there. So we're going to do 585, 570, and then 535. Now here's the dirty little secret about, 535 doesn't have enough juice. I don't like selling cheap options. The first point where you get to a buck is 543. Am I comfortable there? Kind of. Yeah, I'd be all right doing that as the overwrite. I mean, we could probably test it, but that area to me makes some sense. The expected move is 14 bucks, so with IV pumping on a down move, that could definitely see some action. But I'm good with that as at least a hedge. Let's see if I'm going to key that up here. 5, all right, so I lost it because I tried to do the calls before 5. And then let's dump down here to 542. 585, 570, 542. It's a $1.58 debit. I'm going to put it in for $1.50 and see if that fills. GTC. All right, that's loaded in. I'm going to put it in another account also. Let's see, 585. And here's the dirty little secret with this. What happens if the price starts going up or just stagnating? What can I do to reduce my cost of the trade? Well, very simple here, right? All I'd have to do is roll up my overwrite. Or I could even just roll up the lower strike. So in this instance, I could take the 570 up to, let's say, 575, 580. I mean, granted, this starts getting very narrow, but if the market just starts taking off, let's just recoup the cost of the trade. Or I'd probably, more than likely, before I adjusted the $15 wide 585, 570, I would take the 542s probably up higher to maybe 550s or 555s. I think that could make some sense here. So it's currently $1.55. I'm putting the debit in here for $1.50. We'll see if that fills or not. I'm leaving room to add to this in case we get a pumped up VIX, but I definitely like this as at least a hedge against long. So now I'm going to have a good amount of cheap short exposure with asymmetric risk. Often what I'll do with this trade, and I know this takes a little bit more experience, is I'll cover the 1-to-1 when I get the initial dump. Like we talked about this actually. When did we do? We did this. We covered on Halloween actually, the dump down to the 50 MA. We did get the initial bounce, the retest, and then it just took off after that. So we covered perfectly, and then booked the overwrite when we got. Actually, no, I believe it or not, actually still have that overwrite on. I'm just looking. No, this is from the. Oh, I'm sorry. That was booked, and then I had re-upped it. Right, I re-upped it, and I think I got this on either super cheap or with a credit. I'd have to see. This was, of course, the 555, 535, 520. So that's what I did. I remember I covered it, left on the overwrite, and then when we got that gap up, then I booked the overwrite. So that's what I'll often do. I'll wait for the pump to come down, cover that short 1-to-1. Ideally, we get the rally after that, and not only do you have price going with you, but you also have IV contracting. So you get it more expanded on the downside, but then you take it off on the upside, and that's why I usually like to use that overwrite lower strike at somewhere where if I do get jammed, I'm not going to really be, wetting the bed because I know it's at the 200 MA or somewhere along those lines. In this instance, it would be at the 200 MA because we're at 539.22 and rising, and by the time price got there, it'd probably be 542 or higher at that point. So we just got the 2 times range on the ES at 59.74.5, slight overshoot, but bouncing. If we were to check back to the true breakdown point neckline at 6,013.5, I have a secondary neckline, which I will adjust on the charts going forward at 59.90.25. The bulls stalled here at a test of VWAP. Every test so far of VWAP has gotten sold. If you're short, I would be very careful if it got over 6,000.5. That, I think, could get the squeeze up to the 6,013.5 for a quick pump up, maybe even an overshoot to the 200 MA 30-minute at 6,019.5. Qs are futzing around that 2-day low at 21,054.75, a little bit below there. And they need to get up over, I'm going to be a little stricter with the Qs at 21,121.75, and if it clears, that's looking for the 200 MA 30-minute at 21,187.25. The good news for the Qs is that we didn't get the 2 times range yet, so it is showing some relative strength in that regard, even though today it's showing a little bit of weakness relatively speaking, but that would have been 20,902.75, and then the 2.618 is 20,767.5. Again, it just to me looks like mild breath. Actually, the ticks are much improved. We got the negative, wow, it was a negative 1,200 tick on both the ES and the NQ. That's pretty rare to see 1,200. And then we pumped up to almost plus a, did we get the plus 1,000? Yeah, just on the ES, not quite on the Qs. So that shows that the ES has a little bit more short covering. I also have to tell you, I think that you're seeing a lot of hedging mildly coming in. And what do people do when they hedge? They sell futures or they sell index ETFs like SPY against longs. No fill yet on our put spread overwrite. Let me see if that filled. Actually, I think it did fill. Hold on. Yep, it did fill. Why didn't I get the notification? I did get the notification. I just have the sound off. Okay. Little embarrassing there, but we did get the fill on that override for $1.50, and I'll ride that. And like I was saying on the last video, I'll defend that position. And how hard would it be for me to get that $1.50 back? It would be super simple, right? All I have to do is roll up that overwrite from 542 up to whatever strike at that point is $1.50, and I just made the whole thing back. That's the beauty of these trades. The only way you really get your, what's in a ringer here is if it dumps too hard, too fast, and you blow through or test or challenge your overwrite strike fast. If it's closer to expiration, it's no big deal. But if it happens, let's say we had a limit down tomorrow, yeah, I'd have problems, But is that more likely than not? I mean, sometimes those extreme scenarios happen, and if that were to occur, there are ways to defend against it. I'd probably start selling calls or call spreads against it, and maybe I'd even buy some type of a lower strike to cap off that tail risk. I could also, if it starts not working, roll it out to longer, give myself a chance for recovery, and usually just the IV contraction on that helps with that type of a situation. Again, I've done these for many years now. I could count on one hand how many times I've had maybe both hands, over the amount of time I've done it, that I've had trouble over the decades with this. So that's they're usually fairly safe to do. I'm looking at Apple. It's close, right up here to the 20 MA, right? What kind of annoys me is I was going to do Apple the other day, but I wound up, I don't think I got filled. I think the order expired, and here we are right up to where I'd be booking some at the 20 MA. But I posed in my short video yesterday, and I think in the midweek video, that I see the chart a little bit differently than that guy on TV, Carter Worth. I rewatched the segment he was talking about. I didn't see the chart that he posted. Maybe in one of them he did, but the one I saw, I think they just talked about it. So I see Apple differently. And I mean, with charting, it's really a matter of your experience and, you could, I mean, you could look at a painting and see two different things. I happen to see this differently than he does. The way I see it differently is that the 8.5 dump and the 1, 2, 3, 4 days below the range low of the 213.19 to 216.62 was a look below and fail of the range, meaning price tested below range and was uncomfortable and rallied immediately back up over. Probably a little hesitation because of options expirations. We did ultimately, it did take a while, test the higher end of the range, the 232.92 to 237.23. So I view, and we also have a little bit of a mini in-between range there between, let's just say 220, okay, 220 to 221. So I view it as price tested below the range, was uncomfortable, came into range, and then had a minor test above range and then kind of tested the lower end of the range. I see the argument here that we are building out some type of a mini head and shoulders, but to me it just looks like a large consolidation range that has tested more below it than above it, but price is comfortable inside of it. So that's all I see there. I do not view it as the head and shoulders. I'll let you know if there is a neckline breakdown. I would be concerned below 220, and if it really did start taking out 216s to 213s, I think you'd have a pretty fast retest of that 203 to 196 level. But as of right now, I'm not seeing that. Let's take another look at NVIDIA, back green slightly. This just to me looks like consolidation. Bull flag in my view. If you want to put a buy stop over the 149.77 level, if we were to pump up to the yellow channel high, it's 155. They are converging though. The green channel high is only 157.73, so it's the distance between the yellow channel high and the green channel high, the kind of the channel within the channel, or swinger style, the guy behind the guy, is narrowing. So that is okay, I think, is an upper strike. If you want to do 150, 160, I think we had worked this up in the prior video, but I realized we launched, so I will discuss it again. If you want to go out to the earnings week, which is next week, and benefit from that high IV, I told you I was a little leery about the IV percentile being low, only a 49% IV percentile. It's not even over 50%. So that immediately tells